Today's episode is a massive one because whether you already own investment properties, whether you're trying to buy your first home, or whether you're wondering if property investing in Australia is even still worth it anymore, this federal budget could reshape the property market for the next decade. We've now got proposed negative gearing changes to capital gains tax, rising migration forecasts, stronger first home buyer incentives, and potentially huge flow-on effects for rents, supply, construction and property prices. Now, some people think this will finally crash the market. Others are thinking property investing is dead. Personally, I think neither is true. What I think this does is separate strategic investors from lazy investors, because moving forward, strategy is going to matter more than ever.
Welcome to Perth Property Insider, where you will learn how to grow your wealth and improve your life using Perth Property. Our show is brought to you by Investors Edge Real Estate, the highly rated and award-winning property management, sales and buyers agency servicing the whole of Perth. Now, here's your host, Jarrad Mahon.
Welcome back to Perth Property Insider. I'm your host, Jarrad Mahon. So today, I want to break down what has changed, what it means for investors and home buyers, what likely happens to rents, what likely happens to prices, which markets could outperform and which could struggle, and how smart investors adapt from here. Because whether people like it or not, Australia has a major housing shortage still, and I actually think parts of the budget could intensify it. So, what has actually changed? Let's simplify the key changes first. We've got negative gearing changes, which is one of the big headliners. The biggest proposed change in this future, in the future for future investors, is buying established properties is no longer going to be able to negatively gear against their personal income. So instead, negative gearing benefits would largely apply only to new builds, and now existing investors are expected to be grandfathered in, which is the good news for any of us existing property investors. But moving forward, the government is clearly trying to redirect investor demand away from existing homes and towards creating new housing supply. And honestly, from a policy perspective, I understand the goal. Australia desperately needs more homes built. But incentives matter, because when governments change incentives, people change behaviour. Now, let's take a look at the next big headline change, which was capital gains tax changes. So this is the second major proposal to change the capital gains tax discount. And for decades, Australian investors have built wealth through leverage, capital growth, and tax efficiency. And the government is now directly targeting parts of that model. And whether people agree with it politically or not, it changes investor psychology, and psychology drives markets more than people realise. So the actual changes that are getting proposed there is that we've got until the 1st of July 2027 under the current capital gains tax scheme, which is you get a 50% discount if you've held the property for more than a year. After that point, the property price would be indexed, and it would your cost base will be indexed in line with inflation, and then you'll pay a minimum 30% tax, and that will be on gains indexed from that point onwards. So longer term, I've seen modelling that sort of shows that it'd likely impact your longer term internal rate of return by 2 to 2.5%. Which doesn't sound like that much, but it does add up when you've got the compounding effect. So definitely if and when you're selling, it takes a bigger chunk out of your gains, which is, I guess, what they're trying to do with their take more tax. And for those that cycle through properties quicker and have gotten in and out of markets, that's going to be a lot less attractive. And holding for the longer term and buying quality properties that you intend to keep is much more going to be the focus. So, next big issue that is buried but within the budget that people aren't really talking about, And this completely changes the conversation, I think. So Australia is actually, the government is forecasting another 1.4 million people over the next 4 years, according to the Treasury forecasts. And at the same time, we already have housing shortages, we already have low vacancy rates, construction bottlenecks, labour shortages, we have an affordability pressure, and WA alone is forecast to add another 184,000 residents over that 4-year period. And if anything, if the recent past has shown us anything, the population growth tends to be even higher for WA because a lot of people come in via Sydney and Melbourne and then migrate across to WA. So now, whether people actually agree with migration or not isn't really the point here. The point is more people need more housing. And unless supply suddenly explodes, pressure on housing and rents probably remains elevated, which is why I think people expecting a massive property collapse could be disappointed because underlying housing demand is still enormous. So what happens to rents? Now, I want to address something I keep seeing online because whenever rentals prices rising is brought up, people immediately say landlords greedy. And honestly, I think that massively oversimplifies what's actually happening because rents are largely determined by supply and demand. Now, yes, landlords can ask whatever price they want when they put a property up for rent, but the market actually determines whether tenants will actually pay it. And for the last few years, when we layer on inflation that's increased the cost of everything, when interest rates are now increasing again, when we've got insurance increasing, maintenance costs increasing, compliance has increased, and investor risk has increased on the back of all these changes, really shaking investor confidence. Now, on top of that, the government's effectively discouraging investors from buying established rental properties while simultaneously increasing migration forecasts. That combination matters because if demand rises faster than rental supply, rents rise. And that's not greed, that's economics. And personally, I think the government's modelling around rents only rising a few dollars per week is incredibly optimistic and incorrect because even when more new builds eventually come online, a lot of tenants still want established suburbs. They want family homes. They want good school zones. They want lifestyle locations and homes close to infrastructure and employment. Not everyone wants to live in a high density apartment or an outer area estate. So I actually think quality established rentals in desirable suburbs could become even more valuable moving forward. And eventually the rental yields may rise enough that investors say again, you know what, even without the same tax benefits, the returns are attractive enough again, especially if interest rates stay higher for longer, because higher interest rates also increase the yields that investors require to justify the risk of buying into there. And so the supply is going to remain very constrained and maybe even slightly decrease in these well-established, highly desirable locations, which has to increase the rental prices in those areas. So what happens to the building industry? Now, clearly the government is trying to push investors towards creating new supply. That wasn't what I meant when I said partnering with investors. I didn't mean punishing them on one hand and then pushing them towards new supply. And honestly, Australia absolutely does need more homes built. But the issue is, can the building industry actually deliver it? And we've seen how much it struggled when we had the building incentives in 2020. I can't remember what the exact incentive was, but it fueled land getting sold and people building. And it was an absolute shit show with prices going up on the back of inflation around COVID. We could have that same horrible storm coming because we've got inflation increasing the cost of everything. We've got increasing demand now on building new. And I think builders are really going to struggle to, deliver on this. So we've still got a lot of builder insolvencies. We've got labour shortages, high material costs, slow approvals and infrastructure bottlenecks. So even if investor demand shifts towards new builds, supply doesn't magically appear overnight. And construction is still going to take time, and feasibility is still a major issue in many areas. And increasing construction costs is not going to improve feasibility either. But maybe some of the extra demand will help even out the other side of the equation, and it's only going to push some prices up in these areas, I think. So I do think we'll likely see, though, more duplexes getting created, more granny flats getting built to add rental yield, more small developments getting done, especially, and we're waiting for the details to come out, but if you do a small development or add a property to your rear, it's looking likely that that newer property, if then rented out, would hopefully at least qualify you then for the same capital gains tax treatment and the same negative gearing benefits. So I think that's going to be a big incentive for small developments to be done. And even if they don't stack up purely on a profit increase, a return point of view straight away, if they're done in established areas and you're getting those extra tax benefits, I think that's going to sway things more in favour of projects moving ahead. So that is somewhat positive, and it's going to be one of the areas that investors look to. And basically, more value-adding investing is going to be definitely looked at, because the policy is increasingly rewarding investors who create supply. But investors also need to be careful, because whenever governments heavily incentivize one area of the market, oversupply risks can emerge too. And we've seen plenty of investors get sucked into new estate areas over the decades that then have an oversupply situation occurring and have underperformed historically. So just because something's new doesn't automatically make it a good investment, and that's why you need to be incredibly selective and careful when going into that space. So what happens to property prices? Now let's take a talk about the big question. What happens to house prices? Personally, I do not think this causes a nationwide property crash. What I think happens is the market's going to be very fragmented. Some markets are going to weaken, some will stay flat, and some will outperform strongly, because with this budget effectively removing many investors from established property, things start shifting back towards the tried and true fundamentals of real estate. And historically, strongest performers have usually been quality homes in tightly held suburbs with strong owner-occupier demand, limited supply, and good lifestyle appeal. Because when investors step back, owner-occupiers become an even bigger driver of the market, and owner-occupiers buy emotionally, and they pay premiums for better school zones, better streets, larger blocks, lifestyle, and homes they genuinely want to live in. So let's walk through the different price segments, and I'll mention what I think is going to happen in them. So under the 600K segment, there's not very many properties left in there, but sub 600 market could see very strong demand almost regardless of the quality of the property. Why? Because in WA, properties under 600K now attract zero transfer duty for eligible first home buyers, and that's a massive financial and psychological advantage. So for many buyers, removing stamp duty means getting into the market sooner, keeping better buffers, or stretching slightly further in what they can afford. So naturally, demand becomes concentrated in that lower price bracket. And interestingly, I also think some investors will still buy in this segment because yields are often much stronger, and there'll be a likelihood of growth at least over the shorter term in those in that segment.
Just real quick before we continue on with the episode, are you getting my email updates yet? If you're not, you're missing out on our suburb intelligence reports, which we tailor and prepare for your individual suburbs of interest, showing advanced stats and insights. Must get onto those. And I also send out exclusive invitations to our events including webinars, sundowners, and workshops. So if you're not getting those, head on over to investorsedge.com.au/join and make sure you're receiving my email updates.
So if you are an investor looking in that, you still, from our perspective, need to be incredibly selective. You don't want to get yourself into a major headache that you're going to have to deal with and then potentially sell out much sooner than holding the property long term. So even with reduced tax incentives, affordable properties with solid rental demand may still stack up from a cash flow perspective for many investors. And that's why I think this sub 600 price point in Perth and probably across Australia is still going to be very hot. So then we look at the 600 to 865 segment. And I also think this market could remain incredibly competitive because the segment's heavily driven by first home buyers. And right now, first home buyer demand is being supercharged by the 5% deposit scheme. The Keystart increasing its 98% lending up to an 865K price cap. The 5% deposit scheme applies up to 850. So while many people are focused on investors now not buying established, there's also a huge wave of first home buyers gaining purchasing power at the same time. And where are most of them buying? Well, affordable established homes, particularly homes with a decent land component, good locations, lifestyle appeal, and strong fundamentals. Because despite all these policy changes, there's still simply not enough quality supply available in those price ranges. So investors with a bit stronger cash flow, it makes sense to still buy where that demand is going to hold the market up, sub 865, especially if you're looking at, something with value add potential to improve the yield, something that could be developed in the shorter to medium term where you're creating supply and in more established areas. I'm not talking about going and doing this in a new estate with multi-stages coming on in the foreseeable future. So infill within these price points, I think could be a fairly good strategy, providing that you can still cash flow it. And if you can do a cosmetic renovation to improve the rental yield on your entry, then that's going to really help with your holding ability. And not letting too much of the cat out of the bag, but this also sort of highlights why it's not so much about the individual property that you're adding, it's about how you're constructing your overall portfolio, having a balance of asset types, property types. If you don't have the benefits of negative gearing and it's costing a bit more to prop a property up until the rental yield's increased or until it's developed, then you may want to offset that with stronger cash flow, higher yielding properties to balance out your overall portfolio. So I digress there, but I think anything that has that cross-section of buyers, that's going to have a cross-section of some investors still and strong first home buyers, those segments are going to do very well. Now, when we look at the $850 to $1.3 million segment, I think this segment is going to perform relatively well as well because it's largely driven by upgraders and there's still affordability. People can still afford to move into those price points. They're getting their extra equity, so they don't have to take on that much extra borrowing. The first-time buyers are purchasing their houses so they can move into the next price point. They're chasing better school zones, larger homes, lifestyle suburbs, coastal locations, and more amenity ultimately. So upgraded demand is generally more resilient when it still meets affordability because it's emotionally driven rather than having an investment angle to it. So that segment's still going to remain strong. There'll be a few less investors in that segment, but most investors were really sub 850 anyway. So I don't think the demand's going to really drop out of that segment much at all. There wasn't that many investors active in there anyway. And I think that's going to hold up very well. Then when we look at the higher price points outside of those segments, and I'm talking, $1.3, $1.4 million plus, I think conditions could become a bit softer. I think we'll still be in a seller's market, but especially where affordability is getting stretched from increasing interest rates, where borrowing capacity becomes constrained, or where there's a lack of desirability and the property's still, a high price point. I think honestly, properties with those attributes are going to struggle. And I think that higher price points are going to cool, but quality will still be sought after. So the exception there is when it meets all of those lifestyle and highly desirable attributes, then people still will be willing to pay the extra for it. Now, what I want to comment on across all price segments is what I'm seeing day to day. And that is that properties now that have negative attributes are going to be hurt the hardest moving forward, because buyers are becoming much more selective and price sensitive in the face of increasing interest rates and uncertainty. So properties with poor layouts, bad locations, busy roads, poor land content, inferior positioning, or high density oversupply around them could struggle significantly more in this next phase of the market. And that's what I'm already seeing day to day. Because when borrowing power tightens and interest rates go up, quality matters more. And I think we're moving into a market where the gap between A grade and average assets becomes much wider. So what does this mean for investors? If you're listening and you're thinking, well, great, investing's over, I actually disagree completely. I think opportunities still exist, but strategy matters more than ever before. The days of buy anything and just wait are becoming harder. So moving forward, I think investors need to focus more on cash flow because we're not going to get those negative gearing benefits. You can't rely purely on tax benefits anymore. The property still needs to stack up so you're getting growth. So if you are tipping in a bit more per week, you need to be even more sure of your upside of growth and be more selective on what you're purchasing. And ultimately, you need to be ensuring that they have stronger fundamentals to better ensure that you're going to get the capital growth. Next area, in order to ensure that, is you really need to be looking for scarcity. And that still wins long term. Land scarcity, lifestyle scarcity, location scarcity, that hasn't changed. The fundamentals still exist. So I think, you really don't want to be accepting trade-offs or negatives that are too great that are going to impact the desirability for tenants or for resale. And a lot of investors have bought inferior properties over the last few years. We've seen them. They've just got in when they could. They've still experienced growth, but the rules are changing on that. And when home buyers are driving the market, when tenants are still wanting desirable properties to rent, things are changing. So scarcity and fundamentals matter even more. Supply pipelines, I would be really cautioning people to look deeper and understand where huge amounts of stock are going to be coming online, because the government is working on it. They're going to have, really large land releases coming up. They're spending extra on infrastructure to release extra land, because some of these growth corridors today are likely to become the oversupplied areas of tomorrow. So a lot of extra risk when going into those areas. And I think there is the opportunity to purchase new, but you need to be ultra selective on your builder. And I'd be looking at where you can do it in infill locations or where the supply is more constrained and demand and desirability is going to outstrip it. The fourth area, which really sort of dovetails a bit more into scarcity, but this is really sits on top of it, is we need to look at the fundamentals of demographics and look at where the population growth is occurring, both at the city level and down at the individual area and suburb level. We need to look at where the infrastructure is going to drive demand, and I've covered this in various podcasts in the past. Those fundamentals still exist, and we want to be looking at X factors of infrastructure and desirability that are going to be driving, stronger demand than is typical. We want to be, another big part of that is we want to be looking at where employment is and what's bringing people in, and where do they want to live close by to their employment. We want to be looking at wage growth and where stronger demographics are looking to live. And we want to be looking at where affordability and value still is good, where areas are not overpriced, because those areas are going to be most sought after, especially by home buyers. So the fundamentals here still matter enormously. And then the final point, which I think means we need to be a lot more proactive with our strategies, is you'll increasingly see investors focus on granny flats. You need to be very selective with those too. Yes, they can add yield, but sometimes you won't get back the cost of doing the granny flat. There can be challenges with financing and other things that you need to work through. So not a silver bullet. Duplexes and smaller subdivisions in development. Still think you need to be highly selective on your builder. You need to do your numbers, make sure it still is going to stack up and not just be about the tax benefits that you're going to get, but a stronger case for moving those forward. And that will hopefully, sharpen up and make more sense for us. I'm sitting on 4 or 5 properties that can be developed, and that's something I'll be looking closer at. Renovations to increase the yield on the entry. Potentially renovating existing properties that you own to provide a better rental yield in other parts of your portfolio. We need to look at everything through that lens of creating rental yield, because if we can do that on existing properties that we own, that enables us to potentially hold other properties that are going to be growth focused, that might not give you the tax benefits, but you need to be ultra selective on that to ensure that you get the growth. So hopefully you can see how this is all coming together in my thinking, because the market is going to be increasingly rewarded those who create value and create supply. So to recap there, what did that mean for investors? A greater focus on cash flow and yield, a greater focus on scarcity and making sure that you're bulletproof in what you're buying, making sure that you look at supply and what's coming on for an area, and don't be sucked down the pipe of a new estate if there's going to be way too much supply coming on. A greater focus on your demographics and what's going to drive growth longer, medium to longer term. And then I think for those that suit their situation, and it's not for everyone, but having a more active strategy to increase rental yield, to drive better returns, to create new properties that you're going to get those tax benefits on, preferably all within established areas, is going to be the key there, I think. So the bigger picture now, stepping back from all the politics, I think this budget reflects something much bigger happening in Australia. Housing has become one of the biggest political issues in the country, and governments are becoming increasingly interventionist, which means investors need to understand that policy risk is now real, and I'm sure we all do. That means that buffers matter. You want to have strong buffers so that any changes aren't going to cause you to have to sell or make a rash decision. I think diversification is going to matter more, because you want to have a balance within your portfolio and look at your portfolio as a whole and be more open to active value add strategies when you might have been strictly passive before. I think structuring is going to matter. There's changes announced for trusts. You really need to go back, speak to your accountant if you're in that small business position or you own properties in a trust. There's going to be some rollover concessions to change structuring, which I'll certainly be doing. Otherwise, I'm going to have a lot more tax to pay. So structuring is very important. I think we're going to get Ash on from Eventum Group to speak through some of the changes across the board for that you should be thinking of in the accounting area. And ultimately, professional advice and strategy is going to matter more than ever. So I'm here to help our clients move through that, to navigate through it, and to make the best decisions, be their strategic bouncing board. I don't think property investing is dead. I don't think it's even close. I think it's certainly a shock when we first heard all these changes, because ultimately Australia still has strong population growth. It still has chronic undersupply. It has inflation that is going to keep increasing for the foreseeable. It has land scarcity, and it has a culture that's deeply tied to property ownership. So those fundamentals still exist. What's changing is the need for smarter strategy. So to wrap this up, I think this budget absolutely reshapes investor behavior. It creates more complexity, more caution, and it's going to change where demand is focused and where supply is being created. But I also think it creates opportunities because whenever markets become more complex, people often freeze. And it takes a good 3 to 6 months often for people to get their heads around the changes and start to be confident enough to act again. However, the people who continue learning, continue adapting and making strategic decisions usually come out ahead. And let's keep in mind as well that these changes still need to pass through the Senate. They could get altered and changed in order to pass through. And then there's going to be an election in 2028. And I think a lot of people, myself included, will be really assessing where we put our vote and remembering this when we get to that point. And if the government changes over, there could be things getting changed again. We've seen in other countries when negative gearing has been altered. We saw in New Zealand from 2020 to 2024 that it had big negative effects on their market. They were also going through a difficult period on the back of things as well. And they've then reinstated tax deductibility and negative gearing in 2024. So that could very well happen again too, which is worth remembering. So I still think that if you take the approach that we've spoken about in this podcast, you're still going to be rewarded because the next decade may not be rewarding lazy investing like it has done in the past decade. I think it's going to reward smart investing. And I really appreciate you tuning in. If you need some guidance or input on your property decisions, reach out. And if you've gotten value from this episode, share it with someone who needs to hear it, because I think the next few years are going to separate strategic investors from speculative investors more than ever before. I will catch you on the next episode. Just a reminder, the information discussed in this podcast is general in nature. As we don't know your specific situation, you should always seek professional advice before taking any action. For free market reports on your suburbs of interest and other helpful resources to grow your wealth, make sure you join my property investor update at investorsedge.com.au/join. And finally, make sure you're a member of our Perth Property Investment Facebook group to be part of the conversation with other like-minded investors, get help to your questions, and get a feel for what's going on out there in the market. I'll see you in the group.